Happy Tuesday, everybody. I expect a lot of people today with everything that's going on in the markets. I've been getting emails from folks asking me or telling me that they're going to be logging on today. So I expect to see a full house today. It's been a great, I feel like I've been saying it over and over again. It's been a really crazy time in the markets. So we're going to jump in and talk about that. So welcome, everybody. There's a really good article I came about from the Wall Street Journal I'm going to share with you in a bit. But first, let me just check in and just do I'm sure you can see me, but can you see me and hear me okay? Raise your hand, press the button there, raise your hand. Very good. Thank you. So I'm going to share this article with you in a few moments, but let's go through the housekeeping, shall we? So it's May 10th, 2022. Welcome, everybody. We're going to, please remember that you're muted. There is a Q&A section at the bottom of the screen. I'm not going to answer questions about specific securities or anything like that. You probably noticed I don't talk about specific securities on these webinars. So I'm not going to talk about specific investments. If you have questions about that, you can reach out to me. So you are recorded. There is that Q&A. This video will be sent out available on the website if you want to view it again or share it with your friends as they are with every weekly webinar we do and every special webinar we do. All right, well, so we'll go over slot updates. Let me just see if I missed everything or if I got everything here. Yeah, I think we're good. You are muted also. So we'll go over about 15 minutes or so of slot updates. So that has to do with IRA updates, distributions, and then we'll talk about the markets, and we'll talk about the markets for as long as we need to today. And then we'll go into a financial planning topic. The financial planning topic today is rollover mistakes to watch out for. So we've had a couple issues that have popped up with folks that we're working with, folks who are, we appreciate it when people want to take the lead and do things on their own, but sometimes that creates potential problems. So luckily, many of you are now well educated because you've been following these webinars for some of you for years now, and you're hearing these reminders about what to watch out for, what to do. Even if you don't know the correction, you know this is a red flag. I better check on that. So thankfully, this education is working, right? So you all are getting more astute about that, and that's good, because these things, these rollover mistakes are usually something that can't be repaired. All right, so let's do some slot updates. I'm going to share my screen with you. I get a lot of good feedback. Oh, and if David, I'm not sure if you're on the call today, but I was talking to somebody last week, and David mentioned that when we're on these webinars and I'm scrolling, you can hear my scroll, and sometimes it makes it hard to hear me. So that's great feedback. I appreciate that feedback. My son edits the videos. I don't go through my videos. I don't know if you've ever sat and watched yourself on video, but it's not a fun thing to do. And even when I was on the school board, I avoided the videos unless I had to just find a topic that we had talked about, because you find that you're too critical of yourself, and then you end up not having a good time in it. So my point is, I hope you don't, David, if you're listening today, I hope you don't hear the scroll. I did get myself a silent mouse, so I hope it's working well. But really, really great feedback. If you ever want to share any feedback, constructive criticism, or just tell me how great it is, I'll take either one of those. All right, so let's share. Let me share my screen. And this came from feedback also. Someone said, these slot reports are great, but often you're trying to get through the time and not make it too long for us, and it's hard to keep up. So I'm sharing my notes with you. And this first section today is about required minimum distributions, always a big topic. And this is the slot report mailbag. There were many things in the last week in the slot update. Sometimes usually there's a couple. I don't know if it's ever been just one, but there were a lot over the past week. I do know that the Slott group is gearing up for their educational seminars, so maybe they just have more material, or maybe they're getting a lot more questions. So this person writes to Sarah. You've all met Sarah on our webinars. I talked to Sarah this morning already. The question is, I am 75 years old and contributing to my company's 401k plan. I have not taken an RMD, required minimum distribution, for my 401k utilizing the still working exception. I just retired on April 30th of 2022. My question is, do I have to take an RMD for my 401k for the current year, 2022, or am I allowed to wait until April 2023 to commence taking the first RMD from the 401k plan? Really great question from John. So let's talk about the still working exception. So if you're not more than a 5% owner of the company and you're still working, you do not have to take RMDs out of your 401k plan. Yes, of course, you have to still take them out of your IRAs and any non-related 401k. So if you have a 401k at ABC company and you don't work there anymore, and then you have a 401k at XYZ company and you're still working there and you're over 75 or over the age for RMDs or your required beginning date, and you're still working there, you're not more than a 5% owner, then you don't have to take required minimum distributions out of XYZ 401k, but you do have to still take them out of your IRAs and ABC. So it's a way to delay it if you're interested in doing that. So good question John has is, when do I have to take this first one now that I've retired? So the answer is, John, congratulations on your retirement. You have an RMD for 2022 because you retired in 2022. However, because it's the first year for which you must take an RMD, you may delay taking the RMD until April 1st, 2023. Keep in mind that if you do that, you will need to take two RMDs in 2023, the one for 2022 that you delayed and one for 2023, which is now due by December 31st, 2023. So good answer, Sarah. Next question is, hi, if my RMD for my IRA is $20,000, but 5% of my contributions to the IRA were non-deductible contributions, does that mean that I actually have to take more out of the year to satisfy the RMD? So I'm not going to give you the answer to that yet. And thanks, Margie. So when I read this, I had to go look it up. So we can't know everything. We have to know where to go with the answer for the answers to the question. And I had a question regarding something with Sarah early this morning. I've already talked to Sarah. Often my conversations with Sarah or any of them, whether it's Ed, Ian, Andy, Sarah, and this was the conversation today. I said, Sarah, I have this situation. This is what I'm thinking. Am I right or wrong? And most of the time I'm on the right page, or I have the answer correct, just because it's been so long, and you go through these over and over again, and the education is constant. So it's good. But this one, if one of you would have wrote this to me, I would have said, you know what, I have to look that up. And that's okay. So as long as you have the resources to do it. Now, the great thing about the Slott group is that they have these resources, and no other large firm or small firm or nobody has been able to deliver these resources like the Slott group has. They all promised it to me, but nobody has been able to deliver that. I once had a company call me and say they were trying to solicit business. It was an insurance company. I don't remember who it was, but they said they were talking about RMDs, and I told them I was in the they asked me if I knew a couple things. They were kind of challenging me. And I said, yeah, this is how you handle that. So they said, most people don't know that. And I said, well, I'm part of the Ed Slott group. So, it's just something that's kind of always being buzzed in my ear. And they said, oh, we have a resource for that is like Ed Slott, but you don't have to, it costs money to be involved in Ed's group. There's a membership fee, and then there's travel costs. So it's not insignificant. And I did some checking into it. They said, we supply an Ed Slott like person for no cost, and it just wasn't the same. So I don't mean to talk up Ed too much, but there's no other group like this in the country. So here's the next question. If my RMD all right, so so do they have to take more? So let me explain it to you. The RMD is $20,000, but 5% of the contributions from the IRA were non-deductible contributions. Does that mean they have to take out more? Because that really means they're after tax, right? You can't deduct it. So that tax money has already been paid. So do they have to plus up over that $20,000 for that distribution? Is a great question. And Sarah writes back, good news, any funds in an IRA can satisfy an RMD. This includes non-deductible contributions. RMDs do not have to consist of only taxable funds. You will not need to take extra money out because a portion of your RMD is non-taxable. That's really interesting. So good answer and good discussion, Sarah. Let's talk about, and you are still, I didn't check, but I'm sure you're all seeing my screen. Somebody would have told me by now. Yeah, that looks right. So here are a dozen QCD facts. I love this piece, and I'm going to keep this kind of on the top of my, I'm going to pin it to the top of my resources, because QCDs are qualified charitable distributions. They're becoming more and more popular. I'm talking about them more and more. And these are 10 great facts, and this is by Andy Ives. And I don't think you all have met Andy Ives yet, but you will. So qualified charitable distributions continue to gain popularity. I talked about it. So let's just dive into these 10 items about QCDs. So QCDs are capped at $100,000 per person per year, and they only apply to IRA owners, which includes inherited IRAs. Great use of an inherited IRA. If you can't convert inherited IRAs to Roth IRAs. So there's a great use of an inherited IRA. If the IRA owner, inherited IRA owner, is age 70 and a half or older. You must actually be 70 and a half. I talk about this a lot, not just turning 70 and a half later in the year. Now, some of you might be thinking, yeah, but Mark, the new RMD rules say it's age 72. This is another thing that, the IRS and Congress likes to confuse us on with ages. When they raised the RMD age to age 72, they left the QCD age at 70 and a half. It's good. It's good for us because we can do more sooner, but it does make things confusing. Ideally, you could do them at any time, right? Anytime after 59 and a half, you should be able to do it. But that's not the rule. Number two, they can be done from IRAs, Roth IRAs, and inactive SEPs and simple IRAs. Inactive means no dollars went into the SEP or simple IRA for the year. QCDs cannot be done with distributions from employer plans like 401ks. Another good reason you might want to consider rolling your 401k into an IRA. Number three, QCDs must be a direct transfer to a charity. I'm right here. I scrolled during my discussion. Not gifts made to private grant-making foundations, donor-advised funds, or charitable gift annuities. That's right. No QCDs to DAFs, donor-advised funds. No, number four, no split interests of any type will qualify, meaning no part of the QCD can benefit the IRA owner personally. Number five, the charitable donation from an IRA can satisfy a required minimum distribution, but the IRA distribution is not includable in income. That's the beauty of it. If you have a $100,000 RMD, for example, you can send that right directly to the qualified charity, and it doesn't even hit your tax return. No taxable, not included in taxable income at all. No deduction can be taken for the charitable contribution. This would be double dipping. Number seven, let me let it settle for you. For a married couple where each spouse has their own IRA, each spouse can contribute up to $100,000 from their own IRA. They're very specific about that because this is an area people get confused. They try to get tricky. Well, we each get $100,000 QCD, but we're going to take it all from husband's IRA or this person's IRA. It's very specific. In the rule, each spouse can contribute up to $100,000 from their own IRA, and they must, if they don't have $100,000 in the IRA, then you can contribute what you have. It's up to $100,000. If more than $100,000 is withdrawn from the IRA and contributed to a charity, there is no carryover to a future year. The excess is taxable income. However, you might be able to deduct the overage on your tax return if you itemize. You might be able to. Number nine, there can be no benefit back to the taxpayer. No coffee mugs or tote bags, no meals, and this was a real question, no quid pro quo to offer the grandchildren a private school scholarship. So there just cannot be any benefit to the taxpayer. The distribution from the IRA to a charity can satisfy an outstanding pledge to a charity without causing a prohibited transaction. Number 11, the charity must be a valid charity. No human fund, that's from Seinfeld, donations allowed. And she referenced the Seinfeld reference. I like that. I had to say, you know, I was talking to somebody, I'm going to just take a break here. I was talking to somebody, didn't they say 10? Oh, it's a dozen, excuse me, a dozen facts. I said 10. I was talking to somebody last week about, you know, these going and learning about these tax updates. And I can't make it this spring, but in St. Louis this week, I can't make it because you all have scheduled my calendar so much out, but I'm is the Slott event now. We were able to watch it via webinar over the past couple of years, but this one I'm missing, and that's okay. I'm going to make it up in the spring, or excuse me, the fall. I don't like to miss one of those, but they'll send me the books and I'll review them, and I'll still have to take the exam, by the way. But they're a lot of fun. These folks are pretty fun. Ed's a very funny guy, and they, you know, there's a lot of these little references along the way for those of us who remember Seinfeld. So number 12, QCDs, qualified charitable distributions, apply only to taxable amounts. This is an exception to the pro rata rule. Only taxable amounts in a Roth IRA will qualify. So don't bother doing QCDs from a Roth IRA unless you want to have a potential administrative mess on your hands. And a bonus QCD fact, there is no code on a 1099-R that indicates a QCD. So keep good records, because, you know, IRS wants to make things more and more confusing. So let me pause my screen share and see where we are next. Okay, good. All right, so moving on, I'm going to stop my share. So I hope that was helpful and interesting. Let's talk about the markets, folks. So, you know, I'm gonna share this as well as I'm talking about it, because this is from Invesco. I have no ties with Invesco. This is not a recommendation to invest in Invesco. This is just, I use their research that comes in. So I just want to share with you, let me find a pointer here, where we are. This is at the end of the week last week. So not even including the route we had yesterday. But here are our Dow Jones Industrial Average. So these are the big indices we track in the stock markets in the US. And here's all around the rest of the world. So you'll see that last week, so this ends May 6th last week, the markets were down 0.2%, 0.21% for the week, 0.18% for the week, and 1.5%. So the Dow Jones Industrial Average is down almost 9%. The S&P 500 is down over 13%, and the Nasdaq is now well over 22% down. Markets are up slightly today. Last time I looked, they're showing bond yields on my screen right now, but it's like that all around the world, right? Nasdaq being the worst. So it's a very, very difficult time, and it's likely to continue for some time around this level of volatility. But most troubling are the fixed income or bond markets. So we've talked about this before. I've shown you this before. The most popular area for investment of bonds, including target date funds, right, where they automatically adjust you into bond holdings, is this Barclays Aggregate Bond Index. That's down nearly, 10.5%. That's more than anybody expected, and certainly more than any investor expected. But even the very short ones are down -3%. So that's a challenge. And you know the Fed funds rate was you'll see here, Fed funds target last week went up 0.5%. So the week prior it was 0.50%. A year ago it was 0.25%, as it was at the close of the year last year, but now we're up 1% to 1%. So that's an aggressive move. A lot of people think that it's not quite aggressive enough, and it's late. But that's kind of a snapshot of where we are. So it's a very, very challenging time. Many of you people are feeling it, I know. Thankfully, our portfolios are down much less than what we're looking at here. You know, we're holding a lot of cash. In some cases, some portfolios are over 60% cash. So that's a good place to be right now. And we're for our clients, we are still developing this Morningstar trading platform that we're using. Is taking a lot longer to set up than we want it to. So I'm hopeful that we'll be active and get. So we've been doing individual transactions on the Schwab platform, but that's not ideal. So uh, I've been promising you some strategy updates via webinar, and we're going to get there. But I want to have the models live to be able to show you what it's going to look like. So that's the markets review. So I shockingly don't see any questions, but I have to tell you, I'm not too surprised, because you all have been I haven't had any panicked phone calls. I haven't really had any incoming questions even about the markets. And it goes back to this discussion. I remember a newer client about a year ago said, how to react when things like this happen, when markets are down dramatically. And the answer is you don't react. You set it up beforehand. So even though we've been disappointed with our bond funds, and I didn't expect to see the drops that we saw in our bond funds, specifically chose the funds that we use to manage downside protection when interest rates rise. But the effect on bonds has been much greater than anybody anticipated so quickly. So we sold out of most of our bond funds over the past 30 days or so. And that's one of the reasons we're sitting in a lot of cash. But other than that adjustment, you don't typically react to this kind of thing. There are small adjustments you'll make, like we just did with the bond funds, to readjust our portfolio, and it's just good timing, really, because our portfolio structures are going to be very, very different going into the rest of the year than they've been, previously. Because the next few years demand something different. So it's good to make changes, but you don't want to overreact. And that's going to take me into this next article. And this is from the Wall Street Journal, Jason Zweig, I think he pronounces his name. And the article is called The Intelligent Investor, but he references Benjamin Graham's 128th birthday, if he was still alive. And Ben Graham wrote The Intelligent Investor, and it was the first book I read when I started in this business at Payne Weber in 2001. And I wish I had read it earlier, like many of us say, but it's a really great kind of just staple book to have. I've given it out to folks over the years as well, but I'm just going to share again my screen, because I'm not going to read the whole article to you, I don't think, but this is a really good piece. I'm seeing a question here. Doug says, any thoughts about whether there will be a recession? Yeah, Doug, I certainly think that there'll be a recession. I'm not sure if it'll be this year, but very likely to be in 2023. And we could certainly see it by the end of 2022, where all the indicators point there. There are some contrarian views to that, and I'm going to share that in the analytical or in the analyst reports. But I think the Fed's going to have a very, very difficult time managing the inflation. I think that the market's going to continue to struggle over the next year or two, maybe even 3. And I don't think our economy is going to be able to really have any positive growth over that period of time, in a meaningful way. So I think we're due for a recession. I think all the indicators sit there. But again, I think you've got to have a foundation of support for your investments, and we can't just be contrarian or scared, right? And we can't maintain a 64% position in cash, because over a 35-year average retirement, you're not going to have the growth you need, especially if we couple down markets and all the concerns that we have right now with high inflation. It's just a recipe for a really bad, ineffective, and non-performing financial plan and retirement spending plan. So we need to have a growth component. It's not stocks that worry me right now. Listen, I don't like to see my personal portfolio is 100% stocks. I don't have any bonds because of where I am in my life and just my investment style. I'm not suggesting that for you, but I'm not concerned about the stocks that we hold and the stock positions we hold and the ETFs and the stock mutual funds. I'm really not concerned about that from an asset class point of view. It's the fixed income, the bonds that I'm concerned about. And that's why we've made the changes we made. I know the markets will eventually recover, and we're doing all the things we need to do to be positioned for that. But I think a recession is around the corner. I just don't know what corner that is, Doug, but really great question. Let me clear that. Okay, so I'm going to share my screen again, and we'll see. I'll share this article. So Jason writes, and this is a great person to follow. If you have to pay for the Wall Street Journal. I don't know how long you can do a free membership, but I follow. I don't always agree with Jason, of course, just like anyone, but he writes some good pieces. And today is about Benjamin Graham. Really, he was Warren Buffett's mentor, and I like to follow kind of certainly Buffett's thoughts about investing. But Graham knew hardship. He writes, his father died when Ben was only 8 years old, and the family business importing porcelain and decorative objects fell apart. His mother's brokerage account was wiped out in the panic of 1907. Graham never forgot being sent to the bank as a boy and hearing the teller ask whether his mother was good for $5. Then in the crash of 1929, Graham's investment partnerships, let me get my pointer out again, just so we can follow this to get not that pointer. Okay. So in the crash of 1929, Graham's investment partnerships were almost wiped out. He went on to build one of the greatest investment track records of the 20th century, and he never forgot the lessons of loss. So let's pay attention to these. Don't invest using borrowed money, right? That's smart. A lot of people got caught up in that in the early 2000s in margin accounts. Margin accounts aren't bad for very short-term transactions, in my opinion. But you don't want to leverage those investments. Never pay too much for the prospect of future profits. Never count on greater fools to bail you out of a reckless situation or risks. Above all, your results depend much less on how markets behave than on how you behave. So this goes back to, how do you react to this? Well, we really don't react. We make adjustments when we need to, but it can't be reactionary. As fear fills the air and financial markets around the world continue to totter, do yourself a favor and read or reread what I consider the most important paragraph about investing Graham ever wrote. And it may, in fact, be the most important paragraph about investing anyone has ever written. So this is I think the wording in this is difficult, but I'll read it to you. But note this important fact: the true investor scarcely ever is forced to sell his or her shares. And at all other times, he is free to disregard the current price quotation. He need pay attention to it and act upon it only to the extent that it suits his book and no more. Thus, the investor who permits himself to be stampeded or unduly worried by unjustified market declines in his holdings is perversely transforming his basic advantage into a basic disadvantage. That man would be better off if his stocks had no market quotation at all, for he would then be spared the mental anguish caused by other person's mistakes and judgment. So what he's saying, and it's funny how it's all focused on the male version, right? But what he's saying is that, again, try not to be reactive. I think, okay, yeah, making sure I'm sharing. Try not to be reactive and don't make decisions based on what other people are doing. So he talks about the quoted price. So and it's worse, much worse, of course, now, because you can watch your prices all day long, right? You can get, we carry around these little computers in our pocket that tells us exactly what's going on everywhere in the world, including our investments. And you can just be driven by that. It used to be that mutual funds reported, they gave you a statement every year. So a lot of people think, well, that's kind of the way to go. But I don't necessarily agree with that. And I'll come back to that in a moment. But from a day-to-day point of view, I think this makes sense. If a holding makes sense, it probably makes sense to continue to hold it unless there's a fundamental change that's happened. So I think that's a good paragraph. Jason goes on the right. In recent years, investors have been led to believe that their greatest asset is the ability to trade at will for free. And Graham says, no way. And boy, is not true. I told you before that, what's really different today is the volatility and the kind of black box computer models that say, okay, there's this much volatility on the downside. We're going to sell, sell, sell. Now it's heading back up. We're going to buy, buy, buy. No human is making that decision. And your average investor can buy and sell the markets many, many times throughout the day using these things called ETFs or exchange traded funds. So all those things together make for bad decisions from an individual investor and often even portfolio managers, and just too much ease in making these decisions and moving the markets. Okay, so you can find that article. There's a picture of Benjamin Graham here. But the moral of the story is kind of like, have a purpose for your investments and don't sell, don't panic sell. So let me stop that share. We have a question. Walter, Dr. Paul, how are you? It was good seeing you and your wife a couple weeks ago. The YouTube channel, Walter writes, a Swedish investor summarizes investor books. On September 12th, 2018, that summarized Graham's The Intelligent Investor. I'll have to look at that. Thanks for that info. It's a really, it's a, I don't know how many pages the Intelligent Investor is. It's not a Power Zero book. It's not something you read in a couple hours, but it's worth the read. And Doug says Wall Street Journal is available for free through the local library. Is that online also? It's for free. It's available for free, Doug? Yes. Excellent. I see that. I pay for it. Good information. You just saved me $19.99 a year. All right. Now let's talk about some of these analysts and what they're saying. So BlackRock are now reducing risk. So they're reducing some of their stock holdings. So they're saying we slightly reduce risk on worsening macro outlook. So around the world, really, we upgrade European government bonds and investment grade credit and downgrade Chinese assets. The reason behind it, they said, was the Fed raised rates by 0.5% last week, the largest increase since 2000, and signaled similar rises ahead. Long-term yield shot up and stocks gyrated. Data this week may show increasing U.S. core inflation. Everyone's starting to talk about that. There was like one analyst last month that said it's going to be higher than 8.5%. He was talking about 9.24, 9.42. I don't remember. Many others were saying this is the top and we expect it to go down, but now more and more people are saying it's likely to be higher. We see inflation settling at a higher level than pre-COVID. So that's a big game changer for a lot of folks. We adjusted our financial planning assumptions, as I've told you, to 3.5% over the standard we've had for years now, 2.43. And that has made a dramatic, that little more than 1% average has made a dramatic change in most financial plans. We also adjusted our investment assumptions down. So think about that. Inflation's higher, investment assumptions are down. We've got some work to do in these plans. BlackRock further writes, there's another paragraph, but I highlighted this. We also see little chance of a perfect economic scenario of low inflation and growth humming along. So very challenging few years we're going to have. I really hope it's within a 3-year period. It could be as long as 5, but I really hope we can kind of come out of the dark here, within 3 years. Certainly, it'd be great if it's sooner, but we've got a lot to overcome. All right, let's see here. All right, I am just looking. Now I'm scrolling like crazy. I hope you can't hear me. Okay, so Robert D. Lucia's got a bit of a different thought about recession. So to Doug's point, let me read. I don't want to read all his points here. He's talking about investor fear. So he writes, investor fears of an imminent recession, putting it all together. Global bonds have been also declined sharply. So I just talked about that. The bond portfolios for many people are down nearly 10%. They were not considering that. And a 60-40 stock bond portfolio, 60% stocks, 40% bonds, which has been kind of like the staple of it. Well, if you just have a 60-40 portfolio, people have been writing about, then you'll get some growth on the stock side. The bond side will protect you when stocks drop. And that is not happening. And that's why we don't invest that way. But that 60-40 stock bond portfolio was negative 11.5% as of the close of business last week. I think that's when he wrote this. Just stand by. I don't have the date, but I think that's what it was. So that's where investors get shocked. Wait a minute. This asset allocation, 60-40% or 60% stock, 40% bonds was supposed to protect me and make my volatility less. 11.5% is a lot. If it's $1 million, it's 110,000 plus dollars. That's a lot in the short period of time that we have. He writes on, it goes on to continue to write, numerous global concerns weighed on financial markets during the past several months. These include the war in Ukraine, big problem, the surge in energy and commodity prices, economic weakness in China stemming from government-directed lockdowns, and fears of higher interest rates. So all these things are pushing us down. I saw earlier today that one of the utilities in Europe has doubled. The price of home heating or home fuel has doubled over the year, and they're suggesting that people keep their AC at about 83 degrees Fahrenheit. They have they use Celsius there, but it turned out to be about 84 degrees Fahrenheit or 83 degrees Fahrenheit. And they start doing these mitigation strategies to reduce energy. So that's troubling. So this is what investors are feeling in these concerns, right? These are all weighing on us. Pulling it all together, the common denominator of these four factors increased investor fear of a recession, he writes. Pronounced weakness in smaller companies and economically sensitive stocks, and strength in consumer staples and utilities is a testament to the economic fears of investors. He goes on to write, though, that investor fears of an imminent recession are greatly misguided. A recession is inevitable as the business cycle matures, but is not imminent. So it's going to happen over time, but he's saying it's not going to happen right now. Well, the question is really what is over time? I think, as I said, Doug, we could see it by the end of the year for sure. We also have, midterm elections, more in the U.S., just more uncertainty, and that adds to it. So we certainly could see it by the end of the year, but I think 2023 is when the real risk is. An analysis of critical economic forces that trigger an outright recession leads to the conclusion that a sustained contraction in real GDP is unlikely until 2024. So he believes we're not going to see a recession until 2024. He goes on to write, there's never been a recession when interest rates were below the rate of inflation. In addition, the yield curve has steepened in recent weeks and is far from inversion. So we talked about the yield curve a couple of times, but I think just a few weeks ago, and I showed you, the inverted yield curve when it goes down at the end. So interest rates are lower, later maturities, and higher in the shorter term. Typically, it's like a slope up, and that is a good sign. When it's sloping up, that's a good sign that a recession isn't around the corner. So he's writing that the yield curve has steepened, and that's taken because interest rates have gone up, and that's another indicator that the recession is further off. The lag time between the onset of a monetary tightening cycle and the start of a recession has been in excess of 2 years. So a lot of it's going to be driven by the Fed and how heavy on the gas, or the accelerator, I should say, if you're driving an electric vehicle, they're going to be. In principle, recessions result from physical excesses and imbalances in the real economy. However, rather than excess spending and output, most sectors are characterized by shortages, underbuilding, and pent-up demand, most notably spending on business and inventories, capital goods, consumer services, and residential property is below normal. So he doesn't think that there's going to be a recession anytime soon. Many other people do. We'll have to see what happens. And the one other bit I'll read to you is from Riverfront. Hope, they write, hope is not a strategy, but neither is fear. With so many factors impacting the market, it can be tempting to build an investment strategy based on either hope or fear. This week, I'm going to talk about they talk about process over prediction, which is, I like. The key takeaways include falling stocks, stubborn inflation, and worsening geopolitics have made investors fearful. Long-term positives like more attractive valuations and persistent earnings offset the short-term negatives in their view. We are avoiding undue risk, holding extra cash, and focusing on security selection. I think that's prudent. Warren Buffett famously says, be greedy when others are fearful, be fearful when others are greedy. So we are definitely going towards the fear side, but you do have to have a process. So again, how do we manage this? Remember those pillars, right? We have asset allocation, but asset allocation doesn't do it all. Principal protection. All of you that have engaged in principal protection, I know because I hear it, are very, very thankful right now because you have a component, usually a third, sometimes up to a half of your total investments that cannot go below zero. And zero is pretty good right now, considering that often we're taking what would be your bond allocation and putting it into the principal protection, as we expect bond-like returns, 3 to 5%. So taking some of those bonds, putting them into principal protection. And even if you're maturing this year at zero, because you get maturities every year, if you're maturing for that investment at zero, instead of being down 10%, that's a solid win. So asset allocation alone doesn't do it. You'll learn this. You've learned it in my class. If you're attending the class for the first time starting this week, I don't think I mentioned that in the beginning, then you will, but asset allocation alone doesn't do it. This is another example of it. Principal protection, that's another leg of the stool. And account segmentation, that is what finally drives it home. Having your funds allocated for use in certain parts of your life, so you start very conservative, a lot of cash, a little bit of investment, and you grow out more aggressive on your timeline. And then that all cycles down. You can call it the bucketing strategy. You can call it time segmented investing. I call it account segmentation because we use specific accounts. Throw in guaranteed income and you should be very, very comfortable. And that's why our phone doesn't ring with panic. So they're the answers, they are the answers. But look at those statements. I don't believe in not being informed. Look at those statements, be comfortable with where you are. And if you're not, have a conversation. All right. We're over again, but I'm going to run into, because there's a lot to talk about. I'm going to run into our financial planning discussion. So any questions before I move on? I don't see any. So let me go to my whiteboard. All right, I'm going to be looking down as I tell you, because I'm moving my tablet so I can draw on this. But this came up from a couple conversations I had over the past week or two with people writing in with questions, and some of the things I've read on the Slott report, and then some of the things we experience directly with folks we work with. So let me just make this. So the financial planning topic, IRA rollover mistakes to watch out for and avoid, right? Just avoid these mistakes altogether. And if this is going to tell me I can't draw again this week, oh, goodness gracious. Let's see, avoid. So it's really, really easy to avoid these things, but people get caught in these all the time. So let's first focus on the 60-day rollover rule. It's not 90 days. I swear it is not 90 days. It's not 120 days. Oh, I have 120 days to do something with that. No, it's 60 days. What the 60-day rule is, if you take a rollover out of an IRA and you take possession of it, I get it issued to, I take $100,000 out of my IRA and I get it issued to me because I don't know quite what I want to do with it, who I want to deposit it with, or maybe I want to be tricky and say I'm buying a property and I want to use this $100,000. I'm going to sell my other property, and that will certainly happen within 60 days. So because they never get delayed for anything, and then I'm going to put it back into my IRA, and I won't have to pay any tax for it. It's a loan to myself, and I won't have to pay tax. Well, what happens if something gets delayed or you get sick or something like that? Well, 61 days comes without an IRA or IRS approval that you'd have to write in for. There are some automatic, because it's violated so much, there are some automatic approvals for the 60-day rule right now, but we're not going to get into that. On 61 days, that $100,000 now is fully taxable. So no reason to even try that. Because if you're truly doing a rollover, you do what's called a trustee to trustee transfer. So what that does is it says Fidelity, for instance, issues a check payable to, in our case, Charles Schwab, for the benefit of client. Easy. Then if this check is issued as a trustee to trustee transfer, and they issue this check today, 5/10/2022, and for some reason you don't get it to us until 10/10/2022, it's no big deal. Now, I wouldn't suggest you take that long, but it doesn't matter because it's not made out to you. That's the difference. So it can't be used by you. You can't deposit that in the bank if you tried to. So there is no 60-day rule on that. That's the easiest way to avoid it. So don't even mess with it. And don't try the fancy, I could just borrow from my IRA. That is just so much risk. That would keep me up every night if I did that. So that's the 60-day rule. How about this once per year rule? The once per year rule came out some time ago now, but it says that you can, if you choose to do this 60-day rule where you take, and this doesn't apply to trustee transfers, you can do as many of those in a year as you'd like. But if you want to try to do this 60-day rule where you take the money made out to you and then you decide where to roll it over to, you can only do that once per year. And that is not calendar year. No, that is in 12 months. And that is IRA to IRA or Roth to Roth aggregated. So if you did an IRA to IRA rollover within 60 days, and then you wanted to do a Roth to Roth within 60 days, and you did this in December, and you want to do this in May. So this one, if you did it in time and you did it correctly, that's okay. If this one, even if you did it within the 60 days, doesn't count. So you might say, well, that's okay. It's Roth IRA. I don't have to pay tax on it. But what if it's $100,000 that you've worked so hard to get into a Roth IRA and now you can't get it back into a Roth IRA? That's very frustrating. So once per year, and it is over 12 months. People get stuck on this all the time. They'll say, well, I'm going to take a $250,000 rollover. And it may look like this. I'm going to take this $250,000. I'm going to make it easy. I'm going to have it payable to me, and then I'm going to deposit it to my investment account. And then let's make it worse. Excuse me. Let's reverse it. They might do a $50,000 rollover and say, I'm going to put it into from my Fidelity account to my Vanguard account. And I'm not sure where it's going to go. I think that's what I'm going to do, but I'll take it to me, and then the check's just going to sit in a drawer. I'm not going to deposit it, but then I'll get it to Vanguard. So you do that within 60 days, all it's good. And that first $50,000 in the 60-day rule is okay. And then you say, well, that worked okay. So in a couple of months, I'm going to take another $250,000 out of Fidelity and put that in the Vanguard. And I'll do the same thing because that worked fine. So what do you think happens with that $250,000? Because it's within a 12-month window if you did it a couple months later. That $250,000 is fully taxable. No way around it unless the IRS forgives it. So be very, very careful with this once per year rule, IRA to IRA and Roth to Roth, aggregate it. I'm going to talk about call center mistakes. What is a call center? Well, a call center is, I have my funds at Fidelity, I have my funds at Vanguard, I have my funds at T. Rowe Price, whomever. Even Charles Schwab has a call center. I call up the person on the call center, this trained individual, and you say, I want to make a deposit. I have a check. I want to deposit into my IRA, and they give you instructions on what to do with it. Sometimes they are fabulous. Sometimes they know exactly what to do. Sometimes they don't. So I want to share with you a recent example of something that happened with a client. So she wrote to us and she explained this to you. I'm not going to, obviously, no client information, not even the institution, but what she wrote was the IRA funds finally got to the new custodian yesterday, but the new custodian, right, the people receiving the money, wanted to put those funds into my Roth instead of my traditional IRA. So she took money, trustee to trustee transfer, directly. And we had a whole discussion about whether she should do a 60-day rollover, but we convinced her to do a trustee transfer. So that was good. And then the receiving institution received the funds and they said, well, this is a traditional IRA. We know it's a traditional IRA. They said that this has to be put in your Roth instead of the traditional IRA she had there already. They insisted that pre-tax money must go into a Roth. Let me say that again. This trained individual on the other side of the headset there said, no, this pre-tax money, it must go into a Roth IRA. Well, thankfully, actually, she's read the books. She's been on these webinars. She knows enough now. She took the class. She said, what fun I had trying to convince them that was not acceptable. They were adamant. She told them that's not what we want, but they said, no, or that's not what she wants. They said pre-tax money must go into a Roth. But when I said they would owe me $20,000 for taxes on it, they finally backed down and put it in my traditional IRA. I never knew it would be such a fight to get my monies going into the right places. These kind of things, I share it with you. These kind of things happen all the time. So you've got to be careful. You've got to know what to listen for, and you can't let people make these mistakes for you. Happens all the time with these call centers. Often they're excellent. I'll tell you that Jessica from my office deals with 401k rollovers every day. She, there are usually really great people on the other line, the other side of the phone, but there are many times she'll say, no, that's not how it's done. We need to go back and get me somebody else who we can talk to about that. And she's correcting mistakes. Often there are also times that pop up where there's questions and she says, okay, we need to pause on this. We're going to bring Mark into this conversation and see how we address this. Advisor mistakes. If you're not working with a trained advisor who has the resources we have with our Ed Slott group, and I know as I said, I really talk him up, but there are advisor mistakes all the time with these kinds of things. They come in as questions to the Ed Slott group. We read about them in case law with complaints against advisors, firms, and with the IRS. So it happens all the time. So in St. Louis this week, and the packet of material I'll get from the Slott group, there will be a report after report after report of items of advisor mistakes and call center mistakes that have to be corrected by the IRS, or maybe not corrected by the IRS. So, and then they become complaints and you got to deal with that whole thing. So just don't get yourself there. Don't do the 60-day rollover. Pay attention to the once per year rule. If for some reason you do the 60-day rollover, but you can avoid it by doing trustee to trustee transfers. You're doing it now. Educate yourself, know what to listen for. Listen, there's nothing wrong with pulling back and getting us involved. The other thing is client mistakes. So clients try to be helpful, and we appreciate that and say, you know what, I'll handle this myself. I don't need to bother Mark and Jess and his team. I'll handle this myself. So we had a situation, again, a couple of weeks ago, where a client did a rollover himself, appreciate that. And then he got an extra check that the people couldn't tell him about. It was a little over $5,000. And he didn't know where to put it. Well, it was obvious. It seemed obvious to us that it could go directly into his Roth IRA because it was coming from a retirement plan, and it was clearly after-tax money. But it seemed to be after-tax money, but it wasn't clear from the information. And getting somebody on the phone again was a problem. So we had a conversation. I went to the Slott group and asked them what their thoughts were, shared some documentation. We got some direction there, and the client actually was able to clear it up after some time, but it didn't need to be, right? We could have just handled the transfer from beginning to end, and then it's on us first of all. And I have a lot of faith that would have gotten done the first time. So while we appreciate you getting involved in the paperwork and the transfer, we want to make sure it's done right for you. So rely on us, right? And if it's not us, rely on somebody who is trained and qualified. So be careful, because these can be annoying. They can delay things. They can be costly, and you just don't want the IRS involved in your transaction if you don't have to. So I hope that's helpful. And it is 10:56. Okay, we do have a question. Let me see who the question is. once per year does not apply to Roth IRA conversions if using trustee to trustee. No, conversions are different. So I'm talking about rollovers. So Doug, good question again. So conversions are different. Conversions are a distribution, technically. So it's a distribution from your IRA, and then you're allowed to put it into your Roth as a conversion instead of a contribution. So that doesn't apply. In fact, what many people end up doing when they get stuck in that, okay, now I have this $200,000 distribution from my IRA that I don't want, but I've violated the 60-day rollover rule or the once per year rollover rule. What do I do with it? Often the answer is, well, at least you can convert it and put it into a Roth. You're going to pay the tax on it anyway. So great question, Doug. All right, folks, I hope that was helpful, and I hope you have a great week. If you need anything, call us, and I look forward to talking to you all soon. Take care.